that. With this, Nilesh, I just wanted to know your views on asset classes. I mean, given this macro backdrop and whatever is happening around the world and in India, on equities, fixed income, gold. I mean, we've discussed it multiple times, at our investment committee forums. But really now, if an investor were to construct a portfolio or look at his portfolio, what would be your asset class framework?
So Ashish, before I want to go to asset class, I just also want to put a constraint which India faces.
Right.
See, we all believe in fairness, but life is completely full of unfairness. In 2009, Greece was rated higher than India, despite having shaky macroeconomic fundamentals. We do face challenges in this world where white skin gets higher value compared to brown skin, even though blood is red. Now, we have to navigate within these constraints, and which is where many times we are not able to do what others are doing. Someone might get away with a hook shot, but in India's case, if we try to hook, they will probably announce it out, even if the fielder doesn't catches it.
Right.
So rules are different for developed nations and developing nations, and we have to live within those constraints. Right. With that, when we come to asset classes, my one-line assessment is that this is time to be marginally overweight equity. On a P ratio basis, every single stock is highly expensive because earnings have disappeared. But on a market cap to GDP ratio against historical average of 75%, current market cap to GDP ratio is roughly about 70%. That's by and large, marginally overweight equity position. On gold, I will say again, overweight position. It has moved from 1450 to 1800. It may go down a little bit up and down, but over a longer period of time, gold should deliver better return in extremely high liquidity and extremely low interest rate environment.
Right.
On offshore assets, my recommendation will be overweight, primarily to get exposure in those businesses which don't exist in India. On real estate, my recommendation is to remain underweight on commercial real estate, but be bargain hunter in residential real estate, which will be available at bargain prices and hence can give you higher rental yield. The rents are not going to go up. Prices have to come down to get your rental yield.
Right.
And, karma comes back. For decades, real estate developers have taken consumer for a ride. Now it is time for consumers to take these real estate developers for a ride. On the fixed income side, credit space is looking attractive, but this is meant only for those guys who can take one or two knockdowns in terms of delays and defaults. If you are not willing to take risk on the fixed income side in credit space, then better to be invested on duration side. Falling interest rates globally will also bring down interest rates locally, and duration also will be able to give return apart from coupon income, albeit with volatility. So in summary, marginal overweight equity at this point of time, overweight gold, overweight offshore assets, underweight real estate, and if your risk profile permits, be overweight credit, otherwise be overweight duration.
Right. Just to explore a little more, Nilesh, because there has been a lot of chatter around this. We saw a few defaults over the last couple of years, and the credit space in the mutual fund industry has been hit by quite a few challenges in the recent past, and we saw 6 schemes being frozen in one of the AMCs. Of course, since then, things have improved quite a bit. Liquidity has gone up, and I also see in the market that with AAA now, even the AA companies are beginning to get money, and it's becoming easier. So, and the other thing, I think you have constantly been messaging that the total risk in the mutual fund portfolios, if I take the entire mutual fund debt AUM as a basket, the exposure to AA or below names has dramatically shrunk. So if you could just throw some light on this, because investors are really worried after their recent experience, and if you could share a few points as to how
Sure.
it changed.
So one, Ashish, I would like to highlight that delay or a default does not mean total loss. In our own case, we had delay from SL Group in 6 of our FMPs. We had to take a decision whether we sell SL Group papers at throwaway price and pay back our investors, or work with them to recover full price and pay back our investors with a delay. In about 6 months, we were able to recover everything and pay to our investors. There were many WhatsApp warriors and social media gurus who were pushing us to sell the paper and cause loss for our investors. Right. We decided to ignore them, and fortunately, we have been proven right. It was a matter of really satisfaction that when we went to meet half of our investors to explain our decision, they simply said that, Nilesh bhai, we have confidence in you. Whatever decision you are taking will be right for us. You don't have to approach us. Half the investors were obviously worried, but once we explained them the logic, they were with us. Today, all my investors are comfortable with the decision which we have taken. On the other hand, all those social media gurus and WhatsApp warriors, which were advising us to sell our papers at throwaway prices, have now moved on to become China experts. The same tendency got repeated in April when Templeton announced binding of 6 schemes. They went overdrive to tell investors to be aware of credit risk in mutual fund portfolio. They created myth that investors are redeeming from debt fund and person who will be left behind will be holding the crying baby. Today, they are not apologizing to these investors that in the month of May, the same credit risk fund delivered 24 to 36% annualized return or 2 to 3% absolute return as credit spread came down. Bearing Templeton, everyone else continued their operation as usual, even though we were hit with unexpected reductions. And more importantly, people who looked at our portfolios were comfortable staying invested. So my recommendation to investor is that please don't listen to WhatsApp warriors and social media gurus. They have nothing to lose when you lose money. Please listen to your trusted financial advisor who will be interested in protecting you through the volatility. He will give you right advice. Second, please look at the portfolios before taking any decision. In WhatsApp, lots of wrong messages get circulated. Lots of hearsay gets converted into fundamental research. So please be careful about what you hear in social media. Do your own research or take advice from your trusted financial advisor who will be interested in protecting your interest. In the debt fund today, we have seen flows coming in April, May, as well as June, collectively of more than 150,000 crore. This is despite so-called experts and media going against debt funds and spreading all kinds of rumor. In fact, if I look at my debt funds return over 3-year period, and Ashish bhai, I calculated this return at the peak of the crisis on 21st of May. The returns averaged between 7.55% to 9.54%. And in my credit risk fund, despite taking knock on ILFS, Divan and Yes Bank, it is 7% return. Daily liquidity with this kind of return on a 3-year basis is reasonably good performance. And investors who stayed invested through the volatility have generated this return. So my recommendation to debt investors will be trust your advisor. Don't focus on what social media is saying. Those guys have nothing to lose in giving loose comments.
Absolutely. Oh, well put, Nilesh bhai. In fact, just wanted to reiterate that generally even we have seen, Nilesh bhai, amongst our clients, people who have mutual fund portfolios and they've managed risk properly, it's diversified between AAA, AA, single A, they have been far better off than people who directly gone and invested. Even a credit fund, which has had some accidents, has actually come out better than clients who gone and directly invested in papers. Because I know a lot of clients who invested large amounts in certain direct papers, which are actually defaulted. So like you said, bad news travels much faster than good news everywhere. And it's time for the industry to start highlighting good news. I mean, apart from the SL example which you gave, I know a couple of other AMCs also who had certain papers which have got upgraded. In the Franklin schemes, that there is a lot of money which has come back and sitting as cash and will get paid out once this court case clears out. So broadly, I think if you stick with your asset allocation, your diversification, and I've seen it in client portfolios that this is a far better way to participate in asset classes. Thank you, Nilesh bhai, for that. Moving on, from the time you've joined Kotak over the last 5-6 years, the journey has been fantastic. I mean, you manage close to 2 lakh crores of AUM, and I know that you have helped define a very clear framework or investment philosophy across fixed income, equity, and other products. So if you could just give us an overview as to how things are run in Kotak and what is the broad philosophy and framework across teams.
So Ashish, I mean, undoubtedly we have seen great growth in last 5 years, but to give credit to me will not be appropriate. If you notice my entire investment team, they have remained the same. Harsha, Harish, Pankaj, Lakshmi, Deepak, Abhishek, they were all there before I joined, and they are doing good work then, they are doing good work now. What I have done in Kotak Mutual Fund is to ensure that the burden of performance is taken away from fund managers. Fund managers are not God, they are human beings. They'll have their ups and downs. When they are down, they need support. They don't require scolding. As a CEO, it is my job to ensure that I explain to Ashish Shanker why my fund has underperformed. And I'll give you a classical example. There was a particular IT company which my research analyst researched in 2017 and came to conclusion that it is not worthy of investment. It became part of mid-cap index at 1% weight, went up to 4% weight, and our funds underperformed whole of 2017 because of that. At every IC meeting, we were raising doubt that why are you not investing in this IT company which is doing so well? And every time our analyst came back saying that, no, sir, I don't like A, B, and C. We doubted our analyst and supported him through some field research conducted by our sales team across India. And fortunately, they also arrived at the same conclusion which my analyst sitting in Bombay was saying. We remained underinvested that company throughout 2017. And finally, 2018, bubble busted and the company is out of index. Now, this is what is the fund managers need. If he has taken a right call, even if it's going wrong in the short term, as CEO, we have to support him. As CEO, it is my job to reach to my investors, my distributors, my partners, and tell them what we are doing and convince them that what we are doing is right. This gives tremendous space to fund managers to do right thing. And as someone mentioned, investment is not about doing right things. It's all about avoiding doing wrong things. So my job is to ensure that my fund managers do less of wrong things as they are at peace mentally to take short-term underperformance. In equity, our strategy is very simple. People give us money because we are professional. I should not make the same mistake which they are capable of making on their own. Today, Z Group shares are delivering 100%, 200%, 1700% return. Am I supposed to repeat the same mistake for short-term gain? Answer is no. Our philosophy is buy good company, run by good managers at good price. What do I mean by good company? A company whose business is real and whose return on equity over a cycle will be more than cost of capital.
Right.
Gone are the days when we invested in business which was generating 8% return and paying 10% cost of capital. I want to do opposite. Let my business earn 10% and pay 8% cost of capital. good managers. I mean, in the olden days when newspaper used to come home, I used to always start with page 3, Bombay Times. And my wife and my daughter will always question that, Papa, read Economic Times, leave Bombay Times for us. And I said, no, I want to see on page 3 how many businessmen have appeared, because those companies I can avoid to invest. And trust me, by avoiding businessmen coming on page 3 in Bombay Times, I have saved far more money. We want to invest in managers who are young, who are working hard, who are committed to their business, who are not going to cheat minority shareholders. Finally, good price. I mean, everyone wants to buy at good prices, but market is not that kind that because Kotak Mutual Fund wants to buy, it will come down and then it will go up. So how do I create my good price? Well, I have to invest in those companies whose growth going forward will be more than what is expected by the market. As long as I can identify that set of companies whose profitability growth will be higher than expected by the market, I have my margin of safety. So very simple, fundamental approach, buying good quality companies, good quality businesses, run by good managers and at good prices. If we make mistake, and we do make mistakes, we are happy to cut our losses. If we hit a jackpot, we are happy to run our profits. Many of our investments are in our portfolio over the last 5-7 years. We haven't changed them. We gladfully take short-term underperformance for long-term outperformance. I'm not in the business of creating short-term gain for long-term pain. On the fixed income side, our philosophy is SLR, safety first, liquidity second, return third. Today, if you see across my portfolios, we have avoided many of credit risk, which my peers are gladly accepting. It's not that they are going to default. It's just that the credit risk and the price which they are paying is unacceptable to us. We will wait for right opportunity. For me, return of my principal is more important than return on principal, return on investment. In fixed income, better to get 100 rupee of principal back rather than get 1 rupee of extra interest. Second, I run open-ended funds. I have to pay back my investors. So liquidity of portfolio is very critical. You can generate high return by buying illiquid stock, but then eventually you will be trapped on illiquidity. And finally, you have to generate return, no doubt about it, but you have to optimize risk-adjusted return. If I have to sum up my entire investment philosophy, we are in the business of optimizing risk-adjusted return. I have to take risk, but I have to manage it well. And post taking appropriate risk, I have to generate return.
Thank you, Nilesh bhai. I think that was a fantastic overview. To just dig a little deeper on the equity side, I mean, you have different managers like Harsha, you have Harish, and then you have Pankaj in small cap funds. Whilst I understand that the broad philosophy is to buy companies which generate high returns on the capital, run by good managers at reasonable valuation, how much leeway do you allow every manager? Because everyone will have his opinion, and how much is he allowed to express that opinion in the portfolio?
So undoubtedly, my job is to create boundary, and Harsha as CIO also creates boundaries. Within those boundaries, everyone is free to paint their color or play the game as they want. But boundaries are completely cast in stone. Okay. For example, we don't want to invest with chore promoters. Now, this is not compromisable. If Harish, Pankaj, Harsha has a problem with that, they have to go and find another organization. But the good part is that this boundary has been created by them only. It is their collective experience which has given them the wisdom that you don't make money with chore promoters on a long-term basis. The only downside in this is that when those chore company promoters' shares starts performing, their funds will underperform. But we are fine with that. I'm happy to go and meet the world and explain why we are underperforming because we didn't invest in that chore company. Similarly, liquidity of portfolio is critical because we are running open-ended funds. Now, which fund manager would like to create an illiquid portfolio and come under the pressure of selling in desperation? So we build boundaries based on the collective wisdom of our investment team and then give them the flexibility. Each fund manager has the freedom to execute his thought process, but he has to operate within the boundaries of the institution. And this combination gives individual freedom within institutional framework.
Oh, great, Nilesh bhai. Moving on, you also don the industry hat as the AMFI chairman, right? We have seen days where income funds had entry loads, late 90s, and then we saw exit loads on equity funds. We've come a long way, right? From abolishment of entry loads to transparency of commissions around mutual funds, we've seen this entire SIP boom over the last 5-6 years, and even retail investors behaving very, very sensibly. Donning your AMFI chairman hat, now the have also got released for distributors yesterday night. How do you see this industry evolving? What is your advice for people like us? Given the context.
So one, there can't be any dispute on the overall objectives between SEBI, AMFI, and mutual fund distributors. We are all here for serving our investors. We have to do it with utmost governance, best transparency, and with genuine honesty. Will we always add value to our clients? Answer is no. There will be failures. But those failures will not be because we are corrupt, because we are taking shortcuts. Those failures will be because we made error in our judgments in all honesty. These objectives are cast in stone and we are all committed to it just like regulator. Have we achieved everything in order to achieve these objectives? Answer is no, it's a journey. We'll keep on improving as experience comes to us. Now, coming to the distribution fraternity, clearly there are two ways. One, mutual fund distribution, where you get commission from the manufacturer, and second, advisory, where you get paid by the investor. Now, SEBI has differentiated these two streams and allowed a corporate entity to pursue both at the group level. I think it is a very fair decision where if a customer to an organization is on an advisory basis, then there should not be any distribution to him. And if he's on a distribution basis, there should not be any non-incidental advisory to him. When a person is coming to buy mutual fund, of course, you will give advisory related to mutual fund, but you should not be then advising him on real estate and so on and so forth. I think India needs a very, very serious level of distribution. Today, there are many distributors who are into transaction business, who are not into advisory or relationship business. You have to migrate to a level where each family has a family lawyer, family doctor, family chartered accountant. Same way, they need to have family advisor, an advisor whom they can trust, an advisor who is professional, and an advisor who, whether he's a mutual fund distributor or registered investment advisor, is interested in protecting his client's interest. This professionalization of distribution community is extremely important in order to create a scale. If we want to grow this distribution business, it requires professionalization. It requires building up on the platform which has been built by the efforts of distribution community over the years. Unlike many other distribution businesses, mutual fund distribution business is one of the most transparent and least cost model. And we need to continue to build on this platform to take it to greater heights. Today, we are serving 2.25 crore unique investors in mutual funds. The potential is 25 crore unique investors. There is a 10-fold growth in customers and probably AUM, which is possible if we gather our act together.
Right. No, interesting thoughts, Nilesh Bhai. And I personally believe that this could be a pretty revolutionary point in the distribution industry. Like you said, the size of opportunity is very large. And I just hope that the amount of due diligence that people put in to identify a health professional, because, the impact on health is immediate, whether it's a damage or, improvement. Unfortunately, if you do not get a sound advisor, the damage is known over time and it's very, very gradual. So I just hope that this is a turning point and more people turn to professional advice and are willing to pay for, provided, of course, they ascertain that the value addition is there and, all the other hygiene points are ticked. So Nilesh bhai, thank you very much for that. Moving on to the last section, I wanted to also draw from your journey. I mean, you had a fantastic journey. I mean, from being a gold medalist in chartered accountancy, we worked together very briefly in an organization in the late 90s. You've had a fantastic journey. What have been your key learnings? I mean, if somebody is starting out today on the same journey, someone who's graduated or a CA and entering this industry, what are the 2-3 key learnings or advice that you would give to a
I mean, at my age, I think it is always important to work for bigger objective. When I was young, I wanted to be the best performing fund manager. Today, my objective is to enrich my clients, enrich my partners. It doesn't matter whether I'm top performing fund manager or not. When you migrate from lower objectives to higher objectives, somewhere, the universe unites to support you. Maybe it's spiritualism, philosophy, wisdom after health goes away or becomes white. But I think it's important to aim for a higher objective in order to get divine grace, divine support. Second, do what is right. Do what is right for your customers, not for your organization. Ashish, you will remember in 2003, our fixed income fund was more than 6,000 crore. Interest rates were at 5% on a 10-year gilt. For 7-8 years, we had delivered better return than equities, and money was flowing in. Fortunately, not only me, but my entire band of fixed income fund managers across all institutions come together in warning customers to redeem from fixed income funds and move into floating rate funds, liquid funds, or equity funds. We tried actively to lower our AUM in fixed income funds. Today, media may have forgotten this sacrifice, this unique history in the entire mutual fund industry's record in the world. But investors and clients have remembered. They knew we worked for them, not for our organization alone. And that goodwill has helped us to reach where we are today. There was short-term pain in taking that decision, bringing your 6,000 crore fund to 200 crore over a period of time. But it was the right thing to do. And fortunately, all our organizations supported us wholeheartedly. Never even once my CEO complained that, Nilesh, what are you going and talking out in the market and telling investors to redeem? He encouraged us. We launched floating rate fund, which was India's first floating rate fund when there was no concept of floating rate instruments in India. My CEO had problem with that, saying that, Nilesh, how will you manage? And I said, sir, please allow me an opportunity. I will figure out how to manage. And he took chance with me. He took risk with me. What we did was right for our customers, and that is why we have reached here. Always take bigger objective. The whole universe will grace you for doing that. That's my one learning. Do what is right. Don't be afraid of short-term consequences. In the long term, divine grace will support you.
Right. No, absolutely. I think spot on and well said that strive for a higher purpose and things will fall in place. And second, like you said, do what is good. And do what is good, Nilesh bhai, someone told me that, in most situations, you instinctively know what is good. The moment you have to rationalize it, that means you're walking a very, very tricky path, because instinctively the mind and the heart knows in any situation that this is the good path to tread. But then sometimes we tend to rationalize it and do the yeah. Nilesh bhai, any books that you would recommend? Because at Motilal Oswal, we value knowledge a lot and we try to bring insights and more richness and knowledge to our customers. Any 2, 3 books that have influenced you and you would recommend to our clients or you know new practitioners?
Instead of book, I will recommend a habit. Try to read at least few hours a day. If you are very busy, 1 hour a day. If you are very busy, half an hour a day. If you have more time due to lockdown, 3, 4 hours a day. But try to spend some amount of time every day religiously with discipline in reading something. If you can read book, great. If you can go to Google and search a topic and enrich yourself, great. If you can, pick up thousands of email which clog your inbox every day, some of them, great. Try to make a habit of reading and acquiring knowledge part of your day-to-day life. That habit will be immensely rewarding.
Right.
In terms of reading, Ashish bhai, read anything. Everything comes handy. When I was a kid, I used to read Ramayana and Mahabharata. And many a times I was wondering, like, in finance, will this book ever help me? And today, touchwood, I think a lot of examples from Ramayana and Mahabharata are coming handy in explaining concepts of investments to the world. For example, when people say, Nilesh bhai, should I invest direct? Then I said, sure. But do you think you are like Eklavya? Eklavya could learn archery on his own by keeping Guru Dron's pratima or idol in front of him, because he was dedicated, he was disciplined, he was willing to acquire knowledge, skill. Do you have that kind of discipline? Go and be Eklavya. But if you don't have Eklavya's discipline, hard work, tenacity, then please follow Arjun model, which required Guru Dron to teach him archery. The talent of Eklavya and Arjun was the same, but the path was different. So even things like Ramayana and Mahabharata will come handy in understanding market. You can go to the ultimate, books on market. There are thousands and thousands of books which one should read, but this reading habit will be the most important thing. Otherwise, these books will come and it will just line up on your shelves. You don't want to impress outsiders by lining up your shelves. You have to enrich yourself by opening up those shelves and reading those books.
Yeah, well put, Nilesh bhai. I think more than trying to figure out what to read, inculcating the habit of reading itself is a big achievement, and then you'll find your path. Last, Nilesh bhai, I mean, the last 2, 3 months has been pretty disruptive for a lot of us. We are one of the fortunate few to be sitting in good houses and conducting our work from home. But over the last 2, 3 months, what are the big learnings, Nilesh bhai? Because whenever something like this happens, one tends to introspect. And learnings, I would say, at 3 broad levels. I mean, one is for the globe or humanity as a race. Second, India as a country, and personally, I mean, at your level, how has this changed your life, or any learnings that you would like to share?
So one, we have to really become appreciative of everyone else who is supporting you. Many a times in our busy life, running from one place to another place, we probably forgot to thank others who were supporting us, who were contributing to us. That office boy who provided you hot cup of tea, that cleaning person who kept your environment clean, that maid who worked in your house, their contribution was very, very important in your journey. And how many times you turned around to thank them. I think this lockdown has taught me art of appreciation. I have become more appreciative of people who have supported me, who are supporting me during this journey. Second, This lockdown has also bring the importance of self-discipline in front of you. People who are more disciplined in terms of their public-private hygiene, in terms of social distancing, they have done well during this crisis physically. People who took it for granted have paid the price. Like in investment, in real life also discipline gives a very, very important contribution to the success. Third, while we have seen a lot of troubles because of this lockdown in various parts of the country, there are many positives which I have seen in our areas. My daughter loves feeding dog, and we were distributing dog food in and around our area. And it was so fascinating and heartening to see that we were not alone. There were so many people who were willing to, take care of stray dogs, even in the lockdowns. In our area, uh, there are many elderly people whose mates could not come, and they were facing problems of food. And it's a wonderful effort by people of this area, which started supplying food to all of them in the morning and evening and afternoon. And I can legitimately say with pride that it was such a wonderful effort where people kept on supporting each other. We have our MLA, Mr. Amit Satin, and on WhatsApp, I got a forward from an NRI who said how Amit Satin took care of her parents. I mean, these are all the positive stories which we don't hear. My wife works with Isha Foundation, and they were doing wonderful work. I mean, I was busy answering investors' webinar from morning to evening or late night, and she was working even harder than me. And the amount of support, contribution they were able to make through the efforts of all the well-meaning citizens, it may not be recognized in media. It may not be good enough to take out all the pains of the lockdown. But I think they were all candlelights in this darkness. While majority of us focused on the darkness, there were many candlelights which were burning to remove this darkness. And all of us should try to be a candlelight. If collectively all of us burn, I'm sure this darkness will be removed.